Ladies and gentlemen, the next topic that we are now going to be having our speaker on is Market Outlook, a reading of the macros. From debt funds to understanding the macros, let's get an overview of the economic trends impacting Indian markets and what can we expect in medium and long term. I'd like to invite Mr. Dhimant Shah, Head Equities ITI and Mutual Funds, to come on stage. He's a chartered accountant and commerce graduate from Mitabai College. He carries more than 26 years of experience with top-tier track record with marquee Indian mutual funds. Ladies and gentlemen, we have a very interesting session lined up. So the stage is over to him.
Honestly, this is the first session, I'm attending with a strict timeline under the buzzer. So if I kind of don't meet up to the timeline, sorry for that. But really vicious market out there. The external environment is really vicious. Supply side, supply chains getting disrupted. Post-Ukraine, the world has changed. So prior to Ukraine, we were handling COVID, then Ukraine, and that's had repercussions. In a world where, the central banks, unabated kind of supply of money, and suddenly the world changes to 3-4% kind of interest rates, which they have, not experienced in their recent history, has dilapidated the markets, and as a result, ideally, the inflation differentials should also reflect in currency. But this time around, I think the predominant reason why this is not happening and the dollar continues to dominate is essentially because about 70-75% of the world's trade happens in dollars. So, there is no alternate until such time that it pivots or the rate hikes do stop. I think this will not end. And then you have geopolitical, to add to the pressure, you have geopolitical pressures as well, emanating could be from North Korea, China, so on and so forth. So I think world is in a sort of mini turmoil, and today you also have Putin kind of threatening that if Ukraine joins NATO, then it could be a nuclear war. So, I mean, that's the last thing you want. So in terms of Fed rate hike, I think so they have taken 3 hikes, 75 basis, and another 75 basis on cards, looks like. Yesterday, the purchasing power index was disclosed, and it came slightly above expectations. So today they, kind of declare CPI, and which will also kind of add to the Fed's forthcoming rate cycle, and that will kind of be telltale on, what is the future course, whether incrementally they take 50 basis or 75 basis will be. But the market reading as of now is that this rate hike, give or take around 4 quarters, should end, and that's when the dollar kind of recedes. And the Dixie or the dollar index, which is standing at about 113, should technically, peak out somewhere around 120. So clearly, a lot of things going in favor of India as an offshoot, China +1, Europe +1, so on and so forth. So in this bleak picture, I think India is trying to find its own place. We recently dislodged Britain to become the 5th largest. And some of the forecasts available in various foreign broking houses, they see we becoming the 3rd largest by give or take about another 20-25 years. We should become the 3rd largest economy. So the picture is not so great. I think on a 1-year basis, you can clearly see Hang Seng, Kospi, and MSCI emerging. Now, MSCI emerging, I would like you to focus because India now has moved or elevated to the second largest in terms of having weight. So, clearly the dollar is the key reason why the emerging markets has seen so much of withdrawal, because naturally money kind of is weaned away from the emerging markets and they go back to the US dollar, because US dollar, the interest rates are around, well, the bond yields are around 4%. So I think clearly flight to safety. And within that, I think India clearly stands out. So, of course, when there is fire, we say, not only will the uh, soaked up grass burn, but also the green will burn. So I think something of that variety is happening to India right now. Equity market outlook, I think so. To my mind, I think we will broadly be in range of give or take 15,000 to 18,000 for this entire year. And as we possibly head into the next year, uh, somewhere around Jan, Feb, I think the rate hiking by US would kind of recede. So that will be an early indication, and that will be the so the first quarter next calendar year will be the first, kind of uh, so-called, as things stand today and our understanding today. But the only caveat here is we don't need any geopolitical upheaval. So minus that, I think so clearly we are looking at a very bright first quarter in the ensuing calendar year. Uh, Corporates have kind of, done exceptionally well. GDP is also clogging very well, 13.5% growth. And Nifty earnings, although a tad kind of most of the broking houses have kind of, calibrated it downwards, but this is more a reflection of the near term. Next year, I think chances are that, we might upgrade the Nifty earnings. Also, as we head into election year in 2024, major election, I think we, in the past, at least 2, 3 cycles of elections, state government and central government, kind of open up their purses, and you will see a flurry of spending. Right now, the tightness is mainly because the government, and especially some of the state governments, have not yet started spending. So clearly, I think so, and above normal rainfall too has helped. Although there are 2 states, Bihar and Punjab, UP, parts of UP and Bihar. So this belt has suffered. That is slightly concerning as far as the rural recovery goes. So market cap, we are almost close to one-time GDP at 3.3 trillion. We lost only 4% as against, the earlier chart which showed the returns. So clearly a standout. FIIs have been relentless sellers, but fortunately DIIs have stood up. Uh, when the reforms process started early 91, 92, I think the financial holding of Indian households was about 2 or 3%. Even today, as things stand today, it is close to about 7, 8%. So there is such a huge scope. And this number, give or take, would be around more than 50% plus for most developed economies. So that's the kind of potential that we have in terms of, reaching, in terms of the holding in a family portfolio. So right now it is predominated by gold and tax savings and so on and so forth. So I think there is a huge scope for appreciation. Sorry. So only 2 sectors, there was clearly flight to safety. In the last 2 cycles, we have seen IT, pharma, in consonance used to act as a very strong, savers. This time around, the IT sector in particular has not been a savior. for one predominant reason that last two cycles earlier, so we saw transitioning to Y2K where business was just emanating. And then post that, we saw cloud, artificial intelligence, so on and so forth. We are still seeing a lot of developments happening on the IT side. But this time around, I think the predominant factor was that the FIIs were clearly overweight, and they wanted to take money off the table. So both financials and IT sector saw the maximum brunt here. So what was resilient was the FMCG and the pharma sector in particular. So again, almost a repetition of what I said earlier. I think India standing out. Clearly, I think so. YTD about $22.5 billion sold by FIIs and DIIs, kind of more than matching it up in terms of $29 billion allocation. So really, the Indian household is kind of willing to open up its purse and increase its allocation. Currency, which I just mentioned, normally follows the inflation differential and interest rate differential, which is to a great extent reflected in the bond differentials. But for reasons I just mentioned, that dollar dominance is very high, and hence, and till there is no alternate, plus the rate cycle coming to an end will ensure that the dollar kind of recedes. Last but not the least, on the dollar, I think the dominance will have to come down because for ages, they are running about 7-8% current account deficit. At a $90 or $100, we would be around 3.5. But if this time around, again, if oil kind of, exceeds $100 mark, then that would be the key concerning area which has remained and will remain as far as India is concerned. So monsoons, I mentioned we are about at 7% overall, but in monsoon, there are two or three things which one must observe. One is the timeliness, second is the spread, and third is the adequacy. So clearly, with climate change, the good part is that most of the reservoirs are, fairly up there. I mean, our reservoirs are great, and we are seeing robust, so there is rural recovery likely to happen. I'll just spend one more minute on this. Quickly, I think Indian economy is very resilient. 97, when we started most of the reform process, we were 1.3% of the world's GDP. Today, we are at 3.3% of the world's GDP. And if we continue to grow, our past 25 years of growth, we have compounded at $9 in terms of 9% in terms of GDP. If we continue to grow at the same rate, we would be number 3, certainly by 2045-46. So that's, and our per capita income, which is around $2,500-3,000, will move upwards of $10,000, which matches to any developed economy. So that would be a massive change here. GST, RERA, all the other reforms have helped us be very resilient. So I think that's another digitization, stable governance, so many reforms. Today you have most of the states which are even implementing land records which are digitized. So amazing amount of reforms, and we continue to need that. So this is what I mentioned some time ago. I think higher oil prices so far have been more than, or sort of offset by what we export by way of software. And clearly, right now, the Indian currency has appreciated against most of the other currencies like pound, euro, and yen. And these are the major currencies, but depreciated against the dollar. Clearly, the blue line shows that, our inflation differential is actually in our favor. So we are suffering less inflation as opposed to US. The PLI scheme, of course, would ensure that, not only does government do its part, but also the private sector. So capex will continue to happen very robustly. Currently, as per CMI data, the capacity utilization of Indian corporates stands around 74%. Erstwhile, it has been observed as we cross 75 and approach 80% capacity utilization, the corporate India kind of really commits big money in terms of new capexes and so on and so forth. Lastly, some of the industries which will be favorable, auto, cap goods, infra, consumer durables, building materials, and pharma. And some of them that will kind of be neutral, FMCG, BFSI, and so on and so forth. Like I said, the buzzer still managed to beat me a few slides. I can just kind of flip through. So we are at 19 and a half. The mid cap is at a slight, premium. Small cap is at a discount. So we are in the twilight zone of not being too expensive, neither being too attractive. So that's all, friends. Sorry for this slightly short-charged. But the only last thought I would like to leave you with is, we have experienced two major bull markets in our post. One was Harshad Mehta, the other was Ketan Parekh. But be rest assured that we are heading towards such a massive rally and such a wealth creation capability that this country can and will truly deliver. And this is the first time India on its own fundamentals, and because of fundamental reasons, you will see the power emanating, and we will all see that, clearly happening. You won't need any Harshad Mehta or Ketan Parekh to prop us up. India's time is there, strong believer of that. And so stay invested. I think plus or minus 24, 25, 26, I don't know which year, but definitely one of the best wealth creations will happen because this is going to happen on its own legs, own fundamentals. Thank you so much.